So hi Hunter, thanks for being with us.
Hey, how's it going? Thanks again for having me on.
Good. Where are you joining us from?
I'm actually in Los Angeles, California, Mid-City, Wilshire, if you're familiar with it.
Okay, great. Um, so can you tell us about your story in a nutshell, and then we'll dig a little bit more into the different aspects of it?
Sure. So I basically was very insulated from 2008. 2008 was a big wake-up call for a lot of people. For me, it was a green light in terms of my interest in the overall economy and the stock market and finances. I had been interested in economics as long as I can remember and study economics in college. But when 2008 happened, it was really a green light for me to buy when people were really scared. The marketplace was just very terrified. I'm just very naturally a counter-cyclical type of personality. And so that was a once in a lifetime opportunity as far as I saw it. So I started dedicating a lot of time to learning as much as I could about stocks, bonds, mutual funds, of course, because that's what most people are most familiar with, and started investing from my own personal portfolio and had success with that, as most people did. That started in 2008 and really didn't have my first real wake-up call until 2010. And that's something that not a lot of people talk about, but for me, it was just an incredibly powerful moment, which was the European debt crisis. And for those that aren't familiar, very similar to what happened in the United States, but it was with European banks. Many of them froze up. They required additional liquidity. They required government bailouts. And the fact that this was taking place in Europe caused massive volatility all over the world, but especially in the US markets. And so I was just blown away by the fact that after all this research I had done and studying Warren Buffett and Charlie Munger and the like, I would have never been able to predict, let alone mitigate a risk like Greece bond yields and their default rates. And so this was kind of my clue as to how can I find an investment vehicle that produces predictable cash flow but is straightforward enough that I can actually conduct due diligence and mitigate risks. So I wouldn't be exposed to ridiculous and obscure things like the rate of the Greek bond yields. And so that really was a quest that I started on and took me years to really hone that skill. But I was quickly led to real estate because of the timing of the market, was able to leapfrog a lot of the introductory strategies like fix and flipping, and was very quickly introduced to the world of syndications and commercial real estate. And that's what I ended up focusing more on and building ASIM Capital around.
Okay, thanks. Um, in terms of predictable cash flow, can you give us an overview of the principle, the main roles of investing in commercial real estate?
Sure. So, I mean, from a big picture perspective, one of the reasons that I really was drawn to commercial real estate was that I was able to defer to someone else's expertise. There's a very important differentiating factor in investing actively, which is what most people talk about when they invest in real estate, where they may own a property and there may even be a property manager. But if something goes wrong at the property level, that property manager is going to interact with you, the active owner. I prefer to be a passive owner in the sense that there is one person in between me and the manager, the property manager. So I invest passively with operating partners, or what people call sponsors, where all they do is focus on one particular niche. They only buy self-storage in Southeast Florida. And their whole career, they've just bought self-storage, bought self-storage, bought self-storage. As a passive investor, I can identify them as a best-in-class sponsor because they're buying $15 to $50 million properties. There's such a huge discrepancy between a mom and pop owner and a best-in-class owner that they can participate in some of the proceeds of that deal and make up for the fact that they have a lot of expertise. Because if they have 10 properties, they just have such a different strategic advantage than someone that just has one. And so that strategic advantage allows them to be compensated with that without deteriorating the return. So then all of a sudden, I'm presented with a very clear and favorable outcome, which is I can invest passively. My time is not a function of the investment. The risks are not a function of the investment because I'm a passive investor. So the likelihood of me being sued is all but eliminated. And then I can defer to someone else's expertise. When you invest like that, though, it opens up an completely different world because of this concept of diversification. Now I can invest some of my money with someone that only buys self-storage in Southeast Florida. I can invest someone where all they do is retail. I can invest with someone that all they buy is distressed debt. And I can be diversified geographically and from an asset class standpoint, and it completely changes the risk profile of your deal. Now, that's not the totality of why I'm interested in commercial real estate, but that passive approach is critical to building a portfolio that's actually going to generate those predictable returns. And then within the diversification, you get into cash flow and access to debt financing, and the fact that you get really favorable tax laws and depreciation benefits and stuff like that. And just becomes more and more clear that commercial real estate is just an incredible vehicle for growing and protecting wealth.
Okay. And in terms of products, so you mentioned distressed debt, self-storage, retail. I think from listening to your podcast, I think you also invest in mobile home parks?
Yeah, that's right. So the podcast that he's mentioning, just I'll give myself a quick pitch, is the Cash Flow Connections Real Estate Podcast. That's 3 words, Cash Flow Connections. And I've had the opportunity to interview some incredibly sophisticated, savvy industry leaders in a variety of asset classes, as well as economists and authors, people that I have a lot of respect for. And the mobile home park business has been a business that I have been very bullish on for almost a decade now. And some of your listeners, I'm sure, are already familiar with the big picture thesis, but the reality is there's more and more demand for that product. There's demand for that product when times are good. There's demand for that product when times are bad. And then you add this component of the fact that baby boomers, many of them are entering the age of quote retirement, being 65, with very little savings. And they're relying on Social Security as a main source of income. The challenge, though, is that the average Social Security check is actually less or right around the same as the average 2-bedroom apartment in the United States. So you just simply, without savings, you simply cannot rely on Social Security as a main source of income. You will not be able to rent an apartment. So every day there's 10,000 of these individuals hitting that age where they were most likely planning on retiring. The economics are not as favorable as they thought they would be, and they're being pushed into lower income housing. But you compound that with the fact that municipalities all over the country are banning the zoning and changing zoning from mobile home parks to other asset and product types. And every year there's literally less and less mobile home parks. So you have a very interesting supply demand disequilibrium taking place in that business where every year there's more and more demand and every year there's less and less supply. Now, that doesn't paint the whole picture as far as why the mobile home park business is interesting, but it's certainly a massive tailwind that if you position yourself correctly, you can take advantage of it.
Thank you. And so I believe you're invested in self-storage. Can you give us also an overview of this asset class, why you like it?
Sure. So the self-storage asset class is similar to the mobile home park business in that it's recession resistant. I talked a little bit about my story and why the predictability of outcome is so important for me. Part of that is actually the financial implications for sure. But the other part is the economic reality and the emotional reality, being able to plan for the future. That's why most people are interested in investing in real estate. They want to be able to anticipate what's going to happen with a high degree of certainty, even multiple decades down the road, especially if they're planning for future generations. So when I look at investment potential, I want to identify asset classes that are going to perform in all stages of the economic cycle. So self-storage is a great example of that. Why? Because again, when the economy is booming, people buy more toys, they buy boats, they buy jet skis, they buy additional things for their house, etc., and they move other things out. And so that creates demand for self-storage. And of course, when the economy is booming, you can raise rents more effectively because there's more income. Then when the market starts to turn, you have contraction taking place. Well, one of the leading reasons for demand of self-storage is people going through some sort of change in their life, right? So you have kids moving home from college unexpectedly. That's something that's happening right now due to COVID. You've got people downsizing, people changing jobs or being laid off. Just anything that's regarding, the movement of items is going to create demand for self-storage. And this is not just a thesis. This is something that we've seen be proven out not only in 2008, 2009, 2010, but we're also seeing it now in 2020, where the reality is that this is an industrial product that people are going to need when times are bad. And so if you can create an investment vehicle or invest in an investment vehicle that is going to perform and be stable when times are bad and be very good when times are good, you've got the best of both worlds. You know, you may give up some of the upside that some people may experience if they're investing in hotels, for example, but we see what happens every single cycle. Hotels get crushed, Vegas gets crushed, and some markets which are defensive or some asset classes which are defensive are able to weather the storm. So, you know, I'm happy to go through other investment strategies that I implement, but from a big picture, if I can give up a little bit of the upside in exchange for not experiencing that downside, especially since we pool investor capital together as a company, I'm happy to do that.
Yeah, it's also it reminds me of something John Cheng said on your show as to how self-storage appeals to baby boomers as well as millennials. For millennials, it's a lifestyle choice. They can store their surfboard and whatever, and they go then they visit it more often than the baby boomers that use it because they downsize and or inherit some from their parents that passed away and then need a place to store it and put it there because they don't have time to go through it. um, so you also mentioned senior living. Can you explain a little bit more about that, and especially now with COVID? Sorry,
Yeah,
go ahead.
yeah, happy to do it. So, you know, from a big picture perspective, again, this is not news to anyone likely listening to the show, but this a massive demographic shift taking place in the United States, where we're seeing more and more people getting into older age brackets. And for the first time, the older age brackets are actually making up the largest percentage of the population, at least historically speaking. I mean, this is historically significant data. Like, if I'm sure you guys have all seen the charts where you're just seeing the older, the 75 plus, the 65 plus, the 55 plus, all of those numbers are just pushing to the right of the chart. And that's going to create a massive tailwind for that industry. Now, there's a couple challenges with that. First of all, some people have been too early to enter the market based on that thesis, in the sense that people do not typically use senior living when they're 65. They use the product when they're 75 or 85. And so if you were just jumping into senior living 10 years ago just because you thought that tailwind was going to carry your business, you likely hit a lot of headwinds that overwhelm those tailwinds. One of which is the fact that the timing was probably not as optimal as you anticipated. And far more importantly, that business is incredibly complicated and challenging to operate. And if you imagine looking at a line item in Excel where you can see the cells of each different expense and how those expenses can play out and how expensive labor is in different markets, you can be wildly inaccurate with your predictions if you don't know what you're doing. Now, everything I just said makes the business perfect for that passive approach to investing that I just mentioned. Why? Because there's, again, a huge discrepancy between a mom and pop owner and a best in class owner. Because each time that someone can do something wrong, it creates an opportunity for someone to do it overwhelmingly correct. And so that's where we're kind of positioned in the space. Now, as far as COVID, as of the recording of this, it's the end of May 2020. So we're in the middle of, or hopefully the tail end of, some really scary quasi-pandemic, but also perhaps more importantly, government lockdowns, which have really created just unbelievable distress in place. And the senior living business has been one of those businesses where people were originally extremely, extremely worried about the actual health of the tenant base, because it became clear that the vast majority of people who passed away from COVID had pre-existing conditions, and that lends itself to a much older population, kind of very commonly referred to as the people exactly living in senior living. So right now, it's interesting. I'll compare it to the mobile home park or multifamily business, where when you see these massive unemployment numbers, 30 million people, 40 million people unemployed, you start to think, okay, this is certainly going to have a massive impact on collections. People are going to not be able to afford their housing. And we have seen a little bit of that across the nation, right? However, that's not the case with the senior living population. Most of the tenant bases there are not relying on their employment to pay rent. They're relying on savings. They're relying on home equity that they withdrew to purchase or invest or be a tenant in that particular facility, or they're relying on their closest relatives, most of which are making $100,000 or more in jobs which were not closed down due to government lockdowns. So the reason I'm saying this is that you have a unique risk, which is that the concern is that the tenant base may be more likely to have a fatal case of COVID, and because of the close proximity in which people live, there could be a contagion effect that would be more pronounced than if they were just in single family houses, for example. But what you don't have is the challenge with collections. So we've actually seen collections be completely unimpacted by COVID. And we have one senior living facility. We don't have any instances of COVID. But everyone's on high alert. So the challenge there has really been just ensuring that those supplies have been available, make sure people have masks. If you do have someone that's symptomatic of any kind, the quarantine strategies, even before this outbreak, they were already predefined and very understood in this industry. The entire industry of senior living this isn't the first time they started to realize that germs can be contagious inside a senior living property. So they're well prepared for that. So it's interesting. It's something to keep an eye on. I'd say that in the public markets at the height of I would call it hysteria, the senior living properties were down about 50%. Now, we look to the public markets because they're liquid in the sense that our facilities don't trade, so we can't see what the value of those properties is on a daily, weekly, quarterly basis. But you can look to the public markets to get some understanding. I would anticipate that if we don't see the numbers drastically change, those valuations will come back to a large degree. I can speak to some of that. I've been following this very closely. So, several months ago, I believe about 2 months ago, Stanford was the first one to put out a study on the topic, and they estimated that the original fatality rate of about 5% was inflated by about somewhere between 50 and 85 times. People started to take apart that study because it was kind of the first of its kind. Then we started to get more access to antibody tests in Los Angeles and Columbia University, Los Angeles County, USC, and New York City. And all of them showed the fatality rate not in the 5% range, but somewhere in between the 0.1 to 0.5% range. So that's really good news if you're concerned about the health and the likeliness of being dying from or passing away from COVID. The thing that's concerned me is that the narrative has not shifted as this data has become available, so much so that now the CDC about a week ago just put out a report showing that their estimate for the fatality rate is about 0.26%. So I would anticipate this to be like headline news. Of course, it's not, right? There's basically no change. And in fact, some cities are extending their shelter in place orders and requiring even additional and more restrictive stuff. So it's a weird time to be a real estate investor because you think that would be the most important data point. But again, there's other things. And I've interviewed someone from the CDC in my podcast. I've interviewed a microbiologist, and I've also interviewed with someone that kind of sees the world similarly to me. And you can check those out on my podcast if you're interested.
Mm-hmm. Thank you. Very interesting. So going through the different asset classes that you're invested in, I think you're also invested in office space.
I have an investment in office space. It's only something that I've done personally, just one time. And it was not something that we did through our firm, ASIM Capital. And, from a big picture, though, I'd say that the retail and office, they're not exactly the same, but they have some similarities. It's a big question mark. Office in particular, where you have, like I was mentioning, the demographic shifts taking place in senior living, you have this massive tailwind. In office, it seems like you have a very significant headwind. And we have a lot of technology companies in San Francisco in particular that will likely have permanent work from home, at least a place for people to work from home. And I think that that's what that industry is facing. So, I'm not going to say never because that's not wise to say as an investor, but I'm not going to be dedicating my professional energy towards building building a funnel which result in people make, investment in office. If there's an incredible deal with a very high cap rate, then maybe it'd be something I consider on a one-off basis. But in the same way that I talk about the self-storage asset class, the mobile home park asset class, basically every time I'm interviewed, won't be the same for office.
Okay. And I know you've had on your show two people come and talk about retail. One was about 9% cap rates that people were getting.
Right.
Can you tell us about retail and if you're invested in that asset class?
Yeah. I mean, look, we'll start with this. I started this conversation that you and I are having about taking a massive jump into the real estate market at an incredibly favorable time to do so. But when I say incredibly favorable, what that really meant was that your friends and family think you're completely insane, right? Everyone says this is the worst time to do this, and it may be the best time. So, and that's something that is one of my strengths, right? Everyone has their own strengths and weaknesses, and we can definitely talk about my weaknesses, which there are many. But one of my few strengths is being able to go right when most people are looking left. Now, you can get in a lot of trouble doing that, and I have gotten in trouble doing that in the sense I said go right when people are looking left. Well, sometimes it's good to look right before you go right. And when it comes to retail, I have learned that lesson so much that, a year ago, we were hearing all this buzz about the retail apocalypse. And I was just so fascinated by this because there was a delta between what was actually going on at many retail stores all over the country and the media hype. Yes, it is true that Circuit City and Best Buy and Payless and Sears are all having problems, but that is not the makeup of every tenant base that I've ever looked at. There's plenty of nail salons and martial arts studios and pizza restaurants that are doing just fine. In fact, same store gross, income hitting all-time highs. So I have not invested in retail in the last 3 years, but have been adamant about learning as much as I could. In that interview, talking about 9% cap rates, that was one. But that 9% cap rate figure, that's pre-COVID. So what's now happening, you frequently see this in history and in economics, you see this 1-2 punch take place where how many times, from an emotional standpoint, how many times have you heard someone say, well, I lost my job and then I got a DUI and my life has never been the same since. The same is the case for economics, where you can say, okay, the retail industry was struggling because of Amazon and the popularization of online purchases, and they recovered from it. And just when they thought they were out of that challenge, COVID happens, which is completely ahistoric, very hard to prepare for, something like, shelter in place orders. So I guess what I'm starting to say is now the retail apocalypse actually is happening, right? As of the end of May 2020, that challenge that was basically just media hype, now people are actually struggling to pay rent. All those martial arts studios and pizza restaurants, depending on which state they're in, the last few months have been very tough for them. So if you went into those deals with appropriate debt financing and a good solid tenant base, you may be able to weather the storm, especially with the government dollars that have been granted to a lot of these places. But if you went in with a bad tenant base and a lot of very large square footage, in terms of the drawings and such, like where tenants are renting, you're going to have some really serious challenges, especially when it comes to refilling those vacant units. So it's an interesting asset class. I think there's going to be a massive opportunity there actually now. And because now you can actually get some distress in the marketplace, but still very, very skeptical. It's all about debt financing. You have to have appropriate debt or you cannot weather the storm.
Thank you. So in terms of what you actually do, you've mentioned that you were a passive investor, but I know prior to that, you've described yourself as a quasi-passive investor. Hunter, what is it you do?
Yeah, probably should ask that now, given that I've kind of outlined it. So good question. I think that I found myself in a position where I really preferred the passive approach and the diversification that came along with it, and realized that a lot of people probably saw the investment space very similarly to me, but they didn't have the time and they didn't have the contacts. They didn't have the knowledge. They didn't have the expertise. But even if they did, if they're investing $50,000 or $100,000, if they spend 100 hours on due diligence and flying around the country and pulling background checks and preliminary checks and visiting properties, that can eat into your returns. And so I figured a good idea for a business would be to pool investors together so that we could write large checks to these deals that would grant me the economies of scale to be able to continue to do due diligence at a very elite level, a level at which even expert passive investors cannot do because of those economies of scale, and form a business around that using the relationships that I'd curated over the last decade or so. And so that's what we do at ASIM Capital. We have a curated list of operating partners that I've invested with for years, that I personally invested with, and I'm usually one of the largest investors in any of the deals we put together. And we pool our investors. And because we pool our investors together, we usually get access to favorable terms in the sense that a sponsor may require a $2 million minimum investment, where our investors may have a $50,000 or $100,000 minimum. Or we can get more favorable preferred returns or a more favorable split and waterfall, or voting rights. We do whatever we can to negotiate, because rather than writing one $100,000 check, we may write a $5 or $10 million check. And operating partners are very inclined to take those phone calls and allow us to go through much more significant due diligence than they would with one investor. And so that's really how we're positioned as a company. And, I've had the opportunity to be, let's say, a chief investment operator or chief investment officer of other companies, or be the head of their investment relations firm or branch. And I don't want to do it. I don't want to do it because I want to be diversified. And I want my investors to be able to mimic the investments that I'm making from my own personal portfolio. And so I've decided that this is how I want to participate in the business.
Okay, interesting. You just mentioned your own personal portfolio. What is your portfolio like? What's the core of it?
Yeah, sure. So sorry about that delay there. So it's about 30% mobile home parks, 30% self-storage. And that right there, that's 60%. That's the majority of my net worth is tied up into those. I'd say about 10% is in retail, 10% is in debt of some kind, whether that be fix and flip, lending for fix and flip, or distressed debt. And then I do have one investment in a startup, Thrive Market, which has been wildly successful since inception, but particularly since this COVID. It's an online grocer, like an online version of Whole Foods. And it's been crazy. Now, I haven't sold any of my shares, so for me to say it's crazy, it's like, the pre-IPO wealth, which means nothing. But, it's very exciting to watch that grow, and very lucky to be part of it.
Okay, and you've mentioned a few times distressed debt. What can you expand a little bit more about that?
Sure. So this is interesting, right? So the model with distressed debt, there are many, but the one that I find most compelling is buying non-performing seconds behind performing firsts. So imagine someone buying a property. They have a property that's worth $1 million. They have a $500,000 loan on it. They decide to get another loan, a second mortgage for another $100,000, so they can go on a vacation or invest in the stock market or do whatever. Then something changes, either they lose their job or the value of the asset goes down, but they're still paying the first. It shows that they have a lot of pride of ownership and they want to keep the property. They just haven't been able to continue to pay their second mortgage for whatever reason. So the business model is to buy that debt based on a significant discount to the owed balance, and to try to work out a payment plan that actually works for their financial situation. So, if they were supposed to pay $1,000 a month, but they can't afford that anymore, we can buy the product. We can buy the product at such a discount that maybe they weren't going to be able to pay 1,000, but if they could pay 500, it would be wildly successful. So, our goal is not to foreclose and take the property. In fact, excuse me, it doesn't really make sense economically to do that the way that we want to participate in the space. But the goal is to create a workout plan so that people can stay in the property and can continue to keep their house. And so it's very interesting. I think there's going to be a lot of product available given what's going on right now in the economy. But you've got to be careful in this space, because debt collection is really the main risk with anything regarding debt collection is the laws around it. And you could certainly see a situation where in the wake of a pandemic, or at least concerns around a pandemic, you could see legislation, and we've seen legislation banning foreclosures, banning evictions. So you've got to weigh all these things. And I think that, again, one of the benefits of real estate is that it tends to move more like a barge than, let's say, a kayak. in the sense that you're not going to miss a massive opportunity because you did additional research. You're not going to miss a massive opportunity because you wanted to wait an additional quarter or two to see some economic data to see how people react in certain situations. So we're going to wait. We're going to see how legislatively things play out in these states that we're most interested in. And then I do think there's going to be a lot of opportunity. I cannot stress this enough. If you're listening to this right now and some of the terminology I'm using is not super familiar, or you're still like see the learning curve where every single day you learn new and new and new things, I would just ride that wave as long as you can. You know, this is a great show. I would listen to every single episode until you feel like, oh my gosh, I can't take it anymore. I know all this stuff. And only then should you really start investing. Now, that doesn't mean don't go all in on this opportunity. Real estate is an incredible opportunity. It has created more millionaires than any other investment vehicle or asset class in the entire world. But what people don't talk about is it's also created more bankruptcies. So you have to know what you're doing. This is a really complicated and lucrative and competitive space. But the education now, unlike 10 years ago, the education is all at your fingertips. So learn what you can, be cautious, and don't be afraid to take action when the opportunity is there and your knowledge is solid.
Thank you. If you had to start over knowing what you know now, what would you do differently?
Yeah, this is a good question. I'd say, to be honest with you, it's sometimes hard for me because I do love what I do all day and I don't want to like butterfly effect myself out of my current position in the sense that if I had 3 more zeros in my bank account, I think I would be doing this exact interview right now. Like I love sharing what I know and learning from other people and being able to interview people and talking to our investors and building relationships with them. And I just love this space and I'm very passionate about it. But, I'll put it this way. I think that early on in my career, and this is going to sound a little counterintuitive, but early on in my career, I think I focused too much on cash flow in the sense that I was unwilling to exchange buying in a more prime market for lower cap rates. And there's plenty of reasons for that. I don't regret any of the investments I made early in my career. They all worked out very well. And it wasn't luck. It was the result of, well, in part it was luck because I met the right people at the right time, but their guidance allowed me to not rely on luck for the success of my investments. And their guidance was focus on cash flow. But as I started to learn more, here's something that I never would have contemplated 10 years ago. If you can add $100,000 of NOI to a 5 cap, it means a heck of a lot more if you can add $100,000 to a 10 cap. You know what I mean? Like that same strategy of lowering expenses, increasing rents, et cetera. If you can do that same strategy on a proportional basis to a property in Austin, Texas, as opposed to one in Greenville, South Carolina, 35 minutes outside of the city, there's a huge implication for being able to implement that same strategy in Austin. And then when you're in Austin and you're in a 200 unit multifamily apartment that everyone wants to own, all of a sudden you have a lot of friends. And friends mean you don't lose as much money when things go wrong, because that means you got a bunch of lenders, you got a bunch of people that are willing to buy the property, you got a bunch of people that are familiar with the market. And I hate to say it, but it's true. In the world of private equity, let's say you want to sell to a very large fund. These guys, because of the size of what they do and the due diligence that is required for them to move forward, they don't like to take connecting flights. Like, let that sink in a little bit. Like, that's going to limit your investor base if you only invest in tertiary markets where you have to fly to South Carolina, you have to get out in whatever city, you have to drive, get a rental car, go to whatever. It's a different ballgame, and it can work for guys like you and I where we operate a very small ship and we can be agile. But if you want to sell your entire portfolio to a large fund, for example, they're going to nitpick those because they don't have the time to be going in those rental cars all around the country. Just something to think about. And again, let me just say this. That is a very minute point in terms of the totality of what I think about the real estate space. But that's one thing. I think I left some money on the table on a risk-adjusted basis by avoiding more prime markets.
Okay, yeah, that's really interesting. And so we've talked a few times about this podcast of yours. So why did you start a podcast, and what did you gain out of having a podcast so far?
I started a podcast not in the wake of kind of this new revolution in the podcast world, which I'm a huge proponent of, but because I had already built up a network of people that I thought were really intelligent, and I wanted to be able to ask them questions that I was interested in. Now the world of podcasting, the playbook is very clear. It's obviously an incredible vehicle to grow your own brand. It's an incredible vehicle to grow your own network, and it's an incredible vehicle to learn. When I started the podcast, it was basically just because I wanted to learn and to be able to reach out to people that I had a lot of respect for. And so I think you can hear that in our show in the sense that our conversations tend to be longer. They tend to be very detail oriented. If you're a new investor, it's probably not the show for you. But if you listen to 10 episodes, you will likely not be a new investor anymore. You just can't help but learn because the content is a little bit more dense. So my business has been completely revolutionized by the podcast in every sense of the word. You know, the interest in the space, my notoriety, the public perception, and the published in our firm. Not to mention the fact that it's, I think, played a huge role in the way that I view the space and likely positively impacted my ability to see the world through the more accurate perception of risk-adjusted returns, which is what this whole business is about. The name of my company is ASIM Capital, short for asymmetric. So if you can see things on a risk-adjusted basis as an investor, that's another one of those skills that's really, really solid and important.
Thank you. Before COVID, I'm sure you went to real estate investor conferences. Which ones are your favorite?
Yeah, well, I'll go ahead and give myself a pitch because I can't lie. So in terms of passive investors, we create something that I'm just so proud of because it doesn't really exist outside of at least what I have seen. We have something called the Intelligent Investors Real Estate Conference, and I'm actually going to give your listeners a super worthwhile link, which is intelligentinvestorsrec.com. We just gave away, because of COVID, we gave away the last 2 years. All the video sessions are available for free. We're supposed to take it down, but I just haven't told my partners yet. So if you go to intelligentinvestorsrec.com, you can get I think it's 30 hours of our conference. And the conference is done very much with some of our, most pronounced and most well-received guests on the podcast. So go over to that link, check it out. I also, if you're an active owner, I also really like the Best Ever Conference. In fact, I think regardless, you should check it out. Best Ever Real Estate Conference. That's Joe Fairless's and Ben's over at Spartan Investing. And, they're competitors of ours, but we're good friends. And I think we both pitch each other's conferences because we want people to learn and protect themselves.
Thank you. And what is next for you?
I think hopefully more of the same. Like I mentioned, I love what I do. Very, very fortunate and blessed to be able to work with the investors that we've been able to work with, the operating partners that we've been able to work with. And, we have hundreds of investors, but in order to accomplish the goals that we've set out for ourselves as a company, we have to have thousands. And that's what's next. The only way we get there, though, is continuing to deliver for our investors. We make promises to our investors, though not contractually. We make promises that we will dedicate the time and energy and resources available to us to ensure that we're doing everything we can to make our investments perform. And as long as that happens and there's nothing that's wildly out of line that takes place in terms of regulation, which is not off the table, we'll continue to grow. And I'm really excited about that. So yeah, if you're interested in learning more about our investments, asymcapital.com is where our investors look.
And so in terms of returns, what type of returns do you offer your investors?
Yeah, I'd say that low to mid teens. We're not interested unless it can be in that range. And I think that that's something that is achievable in today's climate if you know what you're doing. Now, in all fairness, in 2010, we were underwriting to low to mid teens as well. It's basically the minimum economic moment where it starts to make sense for us to do what we do professionally. Now, some of those deals were significantly ahead of that, but I wouldn't be interested if there was a deal that was collateralized by God himself that was a 5% return. I would just move on with my life and try to find something better. That sounds a little crazy, but it's true.
Okay, Hunter. Well, thank you so much for your time today. I really appreciate you coming to the show.
Yeah, happy to do it.
So have a good rest of the day.
Hey, thanks again. Appreciate it.
So thank you so much. So do you have any feedback? I noticed when you do your podcast, I think it's important also to show that one is also knowledgeable
Hmm.
in the field. Do you think that the podcast went well? Do you have any tips?
Yeah, I did a great job. I'd say that like what you mentioned about the fact that you had done some research and clearly listened to our show and knew like what I was doing, especially when you're getting started, that's important because there will get to a point where you're not going to be able to research all of your guests to the same extent, right? And I mean, I significantly appreciate it and it makes the conversation much more enjoyable because we're both on the same foundation in terms of the starting place. Um, I would say, oh, here's a tip. If you like, as you're doing some research on and thinking about different questions you want to ask someone, you'll probably think of something interesting about the topic, and your listeners are going to be interested in your insight as well. So, like, I can't think of a good example right now, but you know, the self-storage business. You knew I was going to come on and talk about that. There may be some couple of things that you thought about self-storage that I had never thought about, or that I don't mention. So, like, it's always good to kind of be like, oh, I recently saw some interview where this other person said this. Like, what do you think about that? You know what I mean? Just adding your own little thing. And if you're doing it the way that I do it, and like you write out the questions, um, just a little hack. I may write out all my questions in like black ink type, and then I'll put like my little side points in like red. So I know like, you know, I'm not going to send them the questions. If I send them the questions, I'm not going to send them my little side points. So they're not prepared for that because it's kind of cool to have some like more authentic banter, whatever. Just one tip.
Okay, very helpful. Thanks.
Yeah, of course.
Okay, well, I didn't really think about the time difference. I hope it wasn't too much of an annoyance for you to do it.
No, dude, it's all good. This is perfect.
Okay.
No, yeah, I told you, like, if I have 3 more zeros in my bank account, we're still having this exact same conversation. So, like, I'm loving it, man. I appreciate the opportunity.
No problem. Okay, great. Okay, Hunter. Well, thank you so much for your time, and I'll keep listening to your podcast.
Happy to do it, man. Have a good one. Good luck out there. See
Thank
ya.
you. Bye.
Bye.